yeah, yeah. The Amero, the Amero, the Amero. Take me for
Episode 7, What Does the Bank of Canada Do? Welcome back to the kitchen table. I want you to picture 3 different Canadians listening to that exact news broadcast at 10 a.m. on a Wednesday. In Vancouver, a young mother looking to buy her first home sighs in despair. High interest rates mean her mortgage payments will remain unaffordable, trapping her family in a cramped rental apartment. In Alberta, an energy executive smiles. The steady interest rate keeps the Canadian dollar relatively stable, meaning his oil exports remain competitively priced on the global market. But in Toronto, the owner of a small manufacturing firm is frustrated. A stable but weak Canadian dollar means the new high-tech European machinery she needs to buy to upgrade her factory is simply too expensive, stalling her company's productivity. One single rate decision in Ottawa, 3 entirely different realities across the country. Welcome to Season 1, Episode 7 of the Amero Digital Bridge to the FinTech Future. I'm your host, Chesan Lee. Today, we are focusing our lens on the northern half of the continent. For Canadians, the Korean diaspora living in Canada, and global investors, we are asking a critical question. What does the Bank of Canada actually do? How does an institution housed in an office building in Ottawa balance inflation, economic growth, housing affordability, and the value of the currency? Today, we are going to explore the concept of Canadian monetary sovereignty. We will look at why the loonie matters, how a floating currency absorbs global shocks, and the harsh reality of how it creates cross-border friction that hurts our national productivity. Ultimately, if we are going to debate a future digital Amero, we must address the ultimate question. What real value does Canada receive from maintaining a completely independent monetary policy? To understand the Bank of Canada, we have to look past the political noise and look at its legal and historical mandate. Established in 1935, the Bank of Canada operates under what is called the dual responsibility doctrine. Unlike the U.S. Federal Reserve, which has a deeply decentralized structure, the Bank of Canada's power is highly concentrated in the governor. However, if the federal government fundamentally disagrees with the bank's monetary policy, the Minister of Finance has the legal authority to issue a written directive to the governor. If that ever happened, it is widely understood that the governor would be forced to resign. This provides a democratic accountability while keeping day-to-day interest rate decisions out of the hands of politicians seeking re-election. But what is the bank actually trying to achieve? Since 1991, the Bank of Canada has had one primary overriding mission: inflation targeting. In a joint agreement with the federal government, the bank targets an inflation rate of 2%, operating within a control range of 1 to 3%. Research by prominent economists, including David Laidler and William Robson of the C.D. Howe Institute, has shown that this 2% target established a highly successful monetary order in Canada. It anchored the expectations of businesses and consumers. If everyone believes inflation will stay at 2%, workers don't demand massive 10% wage hikes, and landlords don't preemptively double rent just out of panic. But how does the bank achieve this 2% target? Through the monetary transmission mechanism. When inflation runs too high, the bank raises its target for the overnight rate. This is the interest rate at which commercial banks lend to each other. As we discussed in earlier episodes, this rate hike trickles up to your mortgage, your line of credit, and your auto loan. It destroys aggregate demand. People stop spending, businesses lower prices to attract rare customers, and inflation eventually falls. But here is where the bank's mandate violently collides with the reality of Canadian housing and productivity. Let's talk about the housing crisis. Monetary policy is a blunt instrument designed to manage demand. But Canada's housing crisis is fundamentally a crisis of supply. We simply do not have enough homes for a rapidly growing population. When the Bank of Canada raises interest rates to fight broad inflation, it drives up mortgage costs for existing homeowners and makes it incredibly expensive for construction companies to borrow money to build new housing. The bank is trapped. If they lower rates, a flood of cheap credit will pour into the real estate market, causing house prices to skyrocket even further. If they raise rates, they crush the middle class and stall new construction. The Bank of Canada cannot build houses. It can only adjust the cost of money. This leads us directly to Canada's other major economic crisis, productivity. Canada's economic productivity, the amount of value generated per hour worked, has been lagging behind the United States for years. And believe it or not, the Bank of Canada's exchange rate policy plays a massive role in this. Since 1970, Canada has embraced a floating exchange rate for the loonie. The Bank of Canada does not target a specific value for the dollar. It lets the global market decide. The defense for this policy, advocated by Bank of Canada officials like John Murray, is that a floating loonie acts as an essential shock absorber. Because Canada relies heavily on exporting raw materials like oil, lumber, and minerals, we are vulnerable to global commodity price crashes. If world oil prices plummet, the value of the Canadian dollar automatically drops with it. This depreciation acts as a safety valve. It suddenly makes Canadian manufactured goods cheaper for Americans to buy, which stimulates exports, saves factories, and prevents massive unemployment. If we shared a currency with the US, we wouldn't have this safety valve, and the adjustment would have to be made by firing Canadian workers or slashing their wages. But there is a devastating counterargument to the shock absorber theory, and it is vital for our discussion of the digital Amero. Prominent Canadian economists like Richard Harris, Thomas Corchin, and John McCallum have pointed out the dark side of a weak floating currency. It is called the lazy manager effect. When the Canadian dollar drops in value, local exports suddenly become artificially cheaper for Americans to buy. Canadian businesses see a temporary, effortless boost in profits. But because the currency exchange rate did the hard work for them, corporate managers become lazy. They stop investing in new labor-saving technology. They don't buy the latest software. They rely on the weak currency instead of true innovation. Over time, national productivity stalls. And when the currency inevitably rises again, those uncompetitive businesses fail. A floating currency also creates immense cross-border friction. If a Canadian company wants to do business in the United States or Mexico, they have to pay foreign exchange fees to banks, hedge against currency risk, and maintain dual accounting systems. This friction costs the Canadian economy billions of dollars every single year in dead capital. This brings us to the core of the Amero debate. If North America ever transitions to a shared monetary framework, whether through regulated interoperable stablecoins, the XRP ledger, or a formal digital Amero, Canada would have to give up its independent monetary policy. We would lose the floating loonie as a shock absorber. The ultimate question for Canadians is this: is the loss of that shock absorber worth the massive gains in trade efficiency, price transparency, and forced productivity? If a digital Amero forces Canadian businesses to compete on actual innovation rather than hiding behind a weak currency, is that the tough medicine the Canadian economy desperately needs? We must ask ourselves what value we are truly receiving from independent policy when our housing is unaffordable, our productivity is lagging, and our families are paying the invisible tax of currency friction. Before we close today, let's bring this back to the kitchen table with our weekly Q&A. Question 1. If the Bank of Canada only targets inflation, why do they care about the exchange rate at all? Because the exchange rate directly impacts inflation. The bank classifies exchange rate movements into two categories. A type 1 movement is driven by a change in direct demand for Canadian goods, like a boom in global oil prices. A type 2 movement is driven by financial portfolio shifts, like investors moving money to a safe haven. If the loonie depreciates, imported goods like groceries, electronics, and clothing from the US suddenly become more expensive in Canada. This drives up domestic inflation. The bank doesn't target the currency's value, but it must react to it to protect the 2% inflation target. Question 2. How can Canada fix its productivity problem without losing its currency? By focusing on the real economy. Monetary policy cannot solve productivity. Productivity requires removing interprovincial trade barriers, investing heavily in public infrastructure, reforming tax codes to incentivize corporate investment in technology, and deeply integrating our digital payment systems. If we modernize the Finternet to reduce the analog friction of banking fees, businesses will have more capital to invest in their workers. Question 3. What is the call to action for today? I want to hear from the Canadians and the diaspora tuning in today. We have weighed the benefits of a shock-absorbing currency against the costs of the lazy manager effect and cross-border friction. Should Canada preserve its full monetary independence, or is it time to consider a shared North American digital framework? Drop a comment below and tell me why. I'm Chae-Sun Lee. Thank you for seeking the truth behind the money. I will see you next week on the Amero.